Imagine you've invested all of your money into one company. If that company collapses, you've got a serious problem. So you decide to diversify. Instead of owning one company, you own 1,000. Surely now you're safe. Well, not quite. And this is where our intuition gets interesting. We understand that putting everything in one basket is dangerous. So naturally, spreading our money across lots of different investments feels like the solution. And in some ways, it absolutely is. But there's an important distinction between reducing risk and removing risk. And that distinction is where things get interesting. Our intuition says that if we spread our money around enough, eventually the risk disappears. And there is some truth in that. If one company performs badly, owning hundreds of others means that that one company matters much less. But here's the problem. What happens when the one thing affecting all of those companies is the same? Let's make this really simple. Imagine you've invested everything into one company. The company has a terrible year and its share price falls by 50%. You've just lost half of your investment. So instead, you spread that money across 10 different companies. But one of those companies still falls by 50%. That's still bad. But the impact on your portfolio is much smaller. In fact, it's only a 5% decrease across the total portfolio if those 10 companies were equally weighted. And that's diversification doing exactly what it's supposed to do. But now, let's change one thing, because that's a very simplistic example. What if the problem isn't one company? What if the entire economy is struggling? Interest rates rise, businesses become less profitable, and consumers spend less. Well, investors become nervous. Suddenly, lots of companies can fall at the same time. You haven't made a mistake by diversifying. You've simply discovered what diversification cannot do. And I think it's better this way to think about diversification. If it isn't about making your investment risk-free, it's about making sure that one mistake doesn't destroy everything. If you own one company, you're making a very specific bet. If you own hundreds of companies, you're making a much broader bet on business and the economy as a whole. The risk hasn't disappeared. You've changed the type of risk that you're taking. This is one reason diversified index funds are so popular currently. Instead of trying to guess which individual company will succeed, you can own a small piece of hundreds or even thousands of companies. One company can fail without destroying your entire investment. But that doesn't make the investment guaranteed to go up. The whole market can still fall. And that's an important distinction. I think the psychological mistake here is something we see throughout investing. We take a statement that is technically true and turn it into something much stronger. Diversification reduces risk becomes diversification makes me safe. Those two statements sound similar, but they're completely different. So rather than asking, is this investment safe? A better question is, what risk am I actually trying to reduce? If diversification protects me from one company failing, great. But what protects me from the entire market failing? What protects me from inflation? What protects me from the needing of money at the wrong time? For example, retirement. Suddenly the question becomes much more interesting. And this is becoming a bit of a pattern. In the first video, we looked at why cash isn't necessarily safe. Then we looked at why free isn't necessarily free. And now we're looking at why diversified doesn't mean guaranteed. Each time the mistake is slightly different. We're taking something that sounds sensible and asking what it actually means. So here's the takeaway. Diversification is powerful. It can protect you from individual mistakes and individual failures, but it cannot guarantee that your investments will increase in value. Reducing risk isn't the same as removing risk. And that's an important distinction, not just investing, but in almost every decision that we make. This leads us very nicely on to the next question. If diversification doesn't automatically make something safe, what about the price? Surely if something is cheap, it's good value? Well, cheap doesn't necessarily mean something's valuable. And that's what we'll look at next time. I'll see you there.